this revision for advanced audit and assurance, and this the past exam for the September 2021. Question 1. This briefing notes to audit management partner from audit manager subject group code audit planning introduction. These briefing notes are prepared to assist with planning the audit of group code for the financial year ending 30 September 2025. These notes begin by discussing the implication of this being an initial audit engagement and then move on to evaluate the audit risks which should be considered in planning the audit. The notes also recommend the audit procedures to be performed in relation to an investment property. Finally, the notes address the ethical issues arising from a meeting with the company's management team. Initial audit engagement. In an initial audit engagement, there are several factors which should be considered in addition to the planning procedures which are carried out for every audit. ACCA 300 Planning and Audit of Financial Statements provides guidance in this area. ACCA 300 suggests that unless prohibited by laws or regulation, arrangements should be made with the predecessor's auditor, for example, to review their working papers. Therefore, communication should be made with at least associates to request access to their working papers for the financial year ended 30 September 2024. The review of previous year's working papers would help McLean Co. in planning the audit, for example, as it may highlight matters pertinent to the audit of opening balances or an assessment of the appropriateness of reciprocal accounting policies. For example, Alice associates may have information on file regarding previous transactions between Martin Gruber and the company or other related party transactions. It will also be important to consider whether any previous year's auditor's reports were modified, and if so, the reasons for the modification. As part of the client acceptance process, professional clearance should have been sought from at least associates. Any matters which were brought to the attention of MACO when professional clearance were obtained should be considered for their potential impact on the audit strategy. In addition, any ethical issues raised during client acceptance should be considered in terms of their potential impact on the audit strategy. For example, when the need for an independent partner review of the audit, especially given the recent meeting with the company's management and their request for non-audit service to be performed. There should also be consideration of the matters which were discussed with Group Co's management in connection with the appointment of MACO as auditors. The audit team should also consider any major issues which have been discussed with management at initial meetings and how these matters impact on the overall audit strategy and audit plan. For example, the accounting treatment applied to construction contracts may have been discussed given that there is a significant accounting policy applied in the company's financial statements. Particular care should be taken in planning the audit procedures necessary to obtain sufficient appropriate audit evidence regarding opening balance, and the procedures should be planned in accordance with ACCA 510 Initial Audit Engagement Opening Balance. Procedures should be performed to determine whether the opening balance reflect the application of appropriate accounting policy and to determine whether the prior period's closing balance have been correctly brought forward into the current period. With an initial audit engagement, it is particularly important to develop an understanding of the business, including specific legal and regulatory framework applicable to the company. For the audit of group account, it will be important to gain an understanding of the legal and regulatory issues within the oil industry, such as strict health and safety regulations and environmental legislation. This understanding must be fully documented and will help the audit team to perform effective analytical procedures and to develop an appropriate audit strategy. Obtaining knowledge of business will also help to identify whether it will be necessary to plan for the use of auditors or experts. For example, in relation to accounting for customers' identity, whether it will be necessary to plan for the use of auditors experts, for example, in relation to accounting for customer contracts. Further, given the bespoke nature of the orders placed by customers, this may also have an impact on assessing the evaluation of inventory of work in progress. The inventory is industry-specific, so it is highly probable that an expert will need to be engaged to assess the valuation of inventory. McLean Co. may have quality control procedures in place for use in case of initial engagement, for example, the involvement of another partner or senior individual to review the overall audit strategy prior to commencing significant audit procedures. Compliance with any such procedures should be fully documented. Given that this is a new audit client and because of other risk factors to be discussed in the next part of this briefing notes, when developing the audit strategy, consideration should be given to using an experienced audit team in order to reduce detection risks. The audit risks. The first risk is new audit client, and this inherent risk. Okay. This is the first year in which Mark Klein has audited the company, which increased detection risks, as our firm does not have experience with the client, making it more difficult to detect material misstatements. However, the risks can be mitigated through rigorous audit planning, including obtaining a thorough understanding of the business of the company. In addition, as discussed in Part A, there is a risk that opening balance and comparative information may not be correct, as the prior year figures were not audited by McLean Co., and therefore we should plan to audit the opening balance carefully in accordance with IAS 510 to ensure the opening balance comparative information are both free from material misstatements. McLean Co. will need to communicate with at least associates to arrange to review their files to identify any potential issue with prior audits. In particular, McLean will need to investigate in detail the reason why the former auditors resigned from the assignment. Their resignation may, for example, have been the result of disagreements with client management and may be implication in relation to management's competence and or integrity. Management bias. The company's major shareholders, Martin Gruber, is planning to sell his shares in the company, and initial discussions have already taken place with potential purchasers. This situation means there is a risk of management bias in that machine will want to maximize the sale price. For this reason, there is a risk that assets will be overstated the revenue and profitability maximized, as he will want the company's financial statements to reflect a good financial position and performance as possible. Given the owner-managed status of the company, it could be easy for Martin to override controls relating to financial reporting, or to put pressure on the chief finance officer, who is his brother, to manipulate the financial statement. Several of the risks discussed below indicate that management bias could have been applied in a number of accounting treatments, in particular the valuation of investment property and recognition and measurement of intangible assets. Analytical procedures of a statement of revenue and profit. Analytical procedures of financial information provided so that revenue is projected to increase by 15.4%, operating profit is projected to increase by 80%, profit before tax is projected to increase by 55.6%. While there may be relevant and appropriate explanation for the change, auditors should be alert to the possibility that revenue and profit could be deliberately overstated. The trend in operating profit is particularly concerning. The management will need to provide explanation and corroboratory evidence in support of these projections. Machine Group has incentive for the financial statements to show growth in revenue and profit. Given the potential sales of its shares, though, there is a risk of aggressive earnings management. Recognition of revenue support service. The company sells around one quarter of its machines under the contract, which includes the support service, but all contracts are currently being established with only one performance obligation. There's a risk that revenue related to this contract is not being separated into component parts as required by IFRS 15, revenue from contract and customer. IFRS 15 requires that when accounting for revenue, the performance obligation in the contract identified, and where contract has multiple performance obligations, revenue should be allocated to the performance obligations in the contract by reference to their relative standalone selling price. There is an audit risk that Grouper is not disaggregating the contract value between the obligation relating to the supply and installation of machines and the provision of support service. This could result in revenue being overstated if the revenue relating to the support service is recognized at the same time as the rest of the revenue. Recognition of revenue profit. Annual contract, the CFO suggestion that the full amount of profit can be recognized this year in respect of this contract is incorrect. When performing long-term contracts, IFRS 15 states that appropriate methods of measuring progress towards the satisfaction of a performance obligation. The completion of the contract include output methods and input methods, which are based on determination the stage of completion of performance obligation by reference to the value to the customers of goods or service transfer to debt relative to the remaining goods or service promised under the contract. Output method on the basis of the entity's efforts or inputs to the satisfaction of the performance obligation. Input method based on the company's stated accounting policy, which is to use the output method. The state of completion should be based on work certified, which is projected to be $4 million compared with the contract price of $6 million, giving a percentage completion of 66.7%. The company should therefore recognize 66.7% of the estimated $2.2 million profit under contract, which is $1.47 million. Profit is therefore overstated by $730,000. This is material at 5.2% profit before tax. The accounting treatment could be an indication of management bias and the desire of Martin Gruber to overstate profit for the year. The audit team should also consider whether the accounting treatment applied to other contracts devised from the company's stated accounting policy and whether there are further material misstatements in this regard. Johnson onerous contract. The projected profit on 30 September 2025 includes a loss relating to Johnson contract. It is correct that losses should be recognized. However, the method applied of recognizing the loss over time is not appropriate. The total loss on the contract estimated at $840,000 is material as it represents 6% of profit before tax. Where contracts are expected to be loss-making, they should be accounted for on onerous contracts in accordance with IAS 37 provision contingent liabilities and contingent assets, which requires a provision to be recognized for an onerous contract. An onerous contract is a contract in which the unavoidable cost of meeting the obligation under the contract exceeds the economic benefit expected to be received. IAS 37 states the provision should be measured based on the unavoidable cost of fulfilling the contractual obligations. From the information provided, it is not possible to determine the exact amount which should be provided, but recognizing the loss over time is not an appropriate method of accounting, and it is likely that the loss recognized and provision in the statement of financial position are understated. This could be a signal of management bias. The accounting treatment applied reduced the loss recognized within profit for the year and could be an indication of earnings management applied in preparation of the financial statements. There is also a risk that the cost inflation and budgeting errors, which have allegedly caused the contract to become loss-making, will also have implications for other contracts which the company is working on. This may mean that further onerous contracts exist and more losses need to be recognized, providing further risk that profit for the year is overstated. Investment property. The $15 million invested in the Nakatomi building is material, represent 12.5% of total assets. The change in fair value, which is recognized within profit, is also material. Is 14.3% of profit before tax. It is appropriate that the property is measured fair value and that the gain is recognized within profit. This is in accordance with IAS 40 investment properties, which permits entities to choose between a fair value model and a cost model for measurement of investment properties. When the fair value model is used, gains or loss arising from changes in the fair value of investment property must be included in net profit or loss for the period in which it arises. However, no risks arise from the size of the fair value gain which have been recognized. The property was only purchased at the start of financial year, and an increase in fair value of 13.3% in the 12-month period is significant. The valuation of property by the expert has yet to be performed, so the fair value currently included in the financial statement could be an attempt by management to boost profits for the year. For the reasons discussed above, the level of subjectivity which may be involved in determining the fair value increase the risk of material misstatement. The risk is high as Gruber Go may hire an expert who is known to them in order to achieve a higher fair value, which will manipulate the profit for the year, and therefore the objectivity of the expert used is also risk. Intangible asset. The intangible asset recognized in the year cost to the company of $9 million is material to statement of financial position as it represents 7.5% of total asset. It is also material by nature as it is the transaction between the company and the majority shareholder and chief executive officer, making it a related party transaction, which will be discussed in more detail below. There is a risk management bias relating to this transaction. Given that Martin is planning to sell his shares, there is a significant risk that the transaction is an attempt to window dress the financial statement in order to maximize the asset's value, influence the business valuation, and ultimately increase the amount which Martin receives on selling his shares. Martin may also have engineered the transactions as a way to remove funds from the company without having to pay a dividend. It is questionable whether Martin has sold anything at all to the company. Robust audit procedures will need to be performed to determine the existence of an asset in relation to designs which have been sold to the company. They could possibly relate to assets such as patents or some kinds of intellectual property, but both the existence and valuations of such assets need to be supported by the documentation from Martin, which has not been provided to the audit team. The lack of corroboratory evidence increase the risk of this being a fake transactions, which needs to be approached with a very high degrees of professional skepticism. For these reasons, there is a significant risk that intangible assets are overstated by a material amount. There is also a risk that the $10 million opening balance of intangible assets is overstated, especially given that this is a new audit client. Martin may have set up similar transactions in the past, resulting in recognition of intangible assets which may not be appropriate. Related party transaction, the sales of the designs by Martin and Gruber-Co is a related party transaction. According to the definition of IAS 24 related party disclosures, a related party is a person who has control or joint control over the reporting entity. Therefore, Martin is a related party of Gruber-Co, and the sales of his designs is a related party transaction, which is defined in IAS 24 as a transfer of resources, service, or obligations between related parties, regardless of whether the price is charged. There is a risk that disclosures of transaction is not made in accordance with IAS 24, which requires that if there have been transactions between related parties, there should be disclosure regarding the nature of related party transactions, as if information about transaction and outstanding balances, when necessary,